The triple-digit nightmare has returned. $100 a barrel. This isn't a forecast anymore. It is the reality on your screen right now. If you thought the inflation fight was over, if you thought the soft landing was guaranteed, look at the energy markets. The era of cheap energy just ended, and winter 2025 is about to exact a heavy toll on the global economy. Welcome to this urgent market flash. I am your host, and we are breaking down the seismic shift in the energy sector that is happening in real time. Let's cut through the noise. Brent crude has just smashed through the psychological and technical fortress of $100 per barrel. This is not a slow grind, this is a violent breakout. The catalyst? A worst-case scenario unfolding at the world's most critical choke point, the Strait of Hormuz. Early this morning, geopolitical tensions in the region escalated from posturing to kinetic threat. We are not just talking about angry rhetoric. We are talking about a tangible disruption to the physical flow of hydrocarbons. The immediate fallout was instantaneous in the maritime insurance markets. War risk premiums for tankers transiting the strait have skyrocketed by 300% in the last 6 hours alone. Understand what this means. Even if the tankers are not physically stopped, the economics of moving oil have just broken. When insurance costs triple, it acts as a soft blockade. It forces shipping companies to dock their fleets or reroute, effectively removing supply from the market just as demand is hitting its seasonal peak. And that brings us to the second half of this perfect storm, the weather. Meteorologists are confirming that a polar vortex is descending across the northern hemisphere. We are facing a record-breaking cold snap for winter 2025. You have a supply shock meeting a demand shock. You have a strangled supply chain meeting a freezing populace. This is the classic recipe for an energy super spike. Now, let's analyze the ripple effects, because they will touch every corner of your portfolio. First, the macroeconomic picture. $100 oil is a tax on global growth. It sucks liquidity out of the consumer's pocket and transfers it to the producers. For the manufacturing sector, this is a disaster. If you are holding heavy industrial stocks, logistics companies, or airlines, you need to be very careful. Their input costs just exploded. Their margins for Q4 are effectively being incinerated right now. The guidance we will hear in the coming earnings season is going to be ugly. Margin compression will be the buzzword. This also complicates the job of central banks. Just as inflation data was cooling, energy is threatening to ignite a second wave of cost-push inflation. This takes rate cuts off the table. It might even put hikes back on the radar. The bond market knows this. Look at yields ticking up. High energy prices act as a gravity well for the broader S&P 500. However, in every crisis, there is a transfer of wealth. While the broader market bleeds, one sector is feasting. This is where the smart money is rotating, and it is where you need to focus your attention. Upstream Energy. We need to be specific here. Do not just buy an energy ETF blindly. You need to distinguish between the downstream refiners and the upstream producers. Refiners might struggle because high crude prices can squeeze their crack spreads, the profit margin between crude and gasoline. But the upstream players, the exploration and production companies, they are printing cash. Every dollar increase in the price of Brent goes almost directly to their bottom line. Their costs of extraction are fixed. They paid for the rigs years ago. Selling oil at $80 was profitable. Selling oil at $100 is a bonanza. We are looking at free cash flow yields that are about to go through the roof. These companies have cleaned up their balance sheets over the last few years. They are lean, they are disciplined, and they are now cash-generating machines. This is the rotation trade. The capital that is fleeing tech and consumer discretionary sectors due to fear of inflation is finding a home in energy. We are seeing institutional volume pouring into major oil majors and independent E&P stocks. They are effectively the only hedge against the stagflationary environment we are entering. Let's look at the technicals of the Brent chart. The breakout above $100 was accompanied by massive volume. This confirms the move. The resistance has now become support. The next technical targets are $105 and then $112. There is very little overhead resistance because we haven't traded in this range for a long time. The path of least resistance is higher, but we must also analyze the fear premium. How much of this move is panic and how much is structural? The 300% hike in insurance premiums is the key metric. Insurance underwriters are the best risk assessors in the world. They do not raise rates by that magnitude unless the danger is real and imminent. They are pricing in the potential for a total closure of the strait. If that happens, and it is a non-zero probability now, $100 will look cheap. We could see a blow-off top to 120 or higher. This brings us to the psychological aspect of the market, FOMO versus fear. Right now, the general public is fearful of the stock market crashing, but the professional traders are experiencing FOMO for energy exposure. They are realizing they are underweight in the only sector that works in a geopolitical crisis. This chase for performance will drive prices higher in the short term. So, what is the impact on the consumer? We are going to see gas prices climb rapidly at the pump. Heating oil bills will shock households this winter. This destroys consumer sentiment. It reduces discretionary spending on iPhones, on vacations, on luxury goods. This is why you should be wary of the retail sector. The consumer is about to get squeezed hard. Conversely, look at the oil services sector. As prices rise, the incentive to drill increases. The rig counts will go up. The companies that provide the technology, the pipes, and the manpower to extract oil will see their order books swell. This is a secondary derivative play that has significant upside potential. Let's talk about the risks to the bullish thesis. The biggest risk is a sudden geopolitical de-escalation. If a peace deal is signed or tensions cool overnight, oil could drop $10 in a single session. However, ask yourself, does the current geopolitical landscape look like it's heading toward peace or toward polarization? The trend suggests escalation. The risk-reward ratio favors the long side of energy. Another factor is the Strategic Petroleum Reserve, SPR. Governments might try to release emergency stockpiles to dampen prices. But here's the reality. The SPR is already drained from the last crisis. The ammunition to fight this price spike is limited. The market knows the emperor has no clothes. A release might cause a temporary dip, but it won't fix the structural supply deficit caused by a logistical chokehold at Hormuz. Furthermore, we have to consider the currency impact. The US dollar is surging as a safe haven asset. Usually, a strong dollar pushes oil prices down, but today both the dollar and oil are rising together. This is a rare and dangerous correlation. It signals extreme systemic stress. It means cash is fleeing everything else and moving into the two most essential assets, greenbacks and black gold. So, let's synthesize the data. We have a supply shock, Hormuz, insurance. We have a demand spike, winter polar vortex. We have a technical breakout, $100 level. And we have an underinvested energy sector. This is not the time to be a hero in high-growth, high-PE tech stocks that rely on low interest rates. The environment has changed, the regime has shifted. We are back in a resource-constrained world. Here is the strategy for the days ahead. If you are heavily exposed to airlines, transportation, or heavy manufacturing, you need to hedge. Consider buying put options or trimming your positions. The earnings revisions are coming, and they will be negative. If you have cash on the sidelines, this is your entry signal for the energy sector. Look for companies with low debt, high dividend yields, and unhedged production exposure. You want companies that sell their oil at the current market price, not ones locked into contracts at $60. Look at the large-cap integrated majors for stability, but look at the mid-cap E&P players for aggressive growth. Do not chase the vertical green candles blindly. Wait for intraday pullbacks. Volatility will be high. Use the volatility to your advantage. If Brent dips to $98 or $99 to retest the breakout level, that is a buying opportunity. Also, keep a close eye on natural gas. Oil gets the headlines, but the cold weather story is actually a natural gas story. If the freeze is as bad as predicted, natural gas prices will follow oil upwards. The correlation is strengthening. Finally, a word on mindset. Markets like this punish complacency. The buy and hold strategy works in a bull market. In a crisis market, you need to be a tactician. You need to be agile. The situation in the Strait of Hormuz is fluid. It can change hour by hour. You cannot simply buy a stock and forget about it for a month. You need to stay plugged in. The narrative for Q4 has been hijacked. It is no longer about AI. It is no longer about the metaverse. It is about molecules. It is about BTUs. It is about keeping the lights on and the factories running. Energy is the master variable. And right now, the master variable is flashing red. To conclude, the $100 barrier is broken. The winter is coming. The supply chain is fractured. The cost of doing business has just gone up. The call to action is clear. Stop ignoring the energy sector. Stop hoping for prices to come down. Trade the market you have, not the market you want. Review your portfolio today. Reduce exposure to energy-sensitive industrials. Increase allocation to upstream oil and gas producers. The window to position yourself before the full impact of Q4 earnings hits is closing. The smart money moved yesterday. The observant money moves today. The victims move tomorrow. Which one will you be? Stay sharp, stay liquid, and keep your eyes on the ticker.